Before diving into specific stocks, you must first understand yourself as an investor. What are your financial goals? Are you saving for retirement, a down payment on a house, or your children's education? Your goals will dictate your investment timeline and risk tolerance. A longer time horizon allows for greater risk-taking, as you have more time to recover from potential losses. Conversely, if you need the money sooner, a more conservative approach, focusing on stability and lower risk, is crucial. Consider your risk tolerance honestly. Are you comfortable with potential volatility, even significant losses in the short term? Or do you prefer a more stable, albeit potentially slower-growing investment strategy? This self-assessment is paramount. Ignoring your risk tolerance can lead to impulsive decisions and potentially devastating financial consequences. Diversification, your shield against risk. Once you've established your goals and risk tolerance, the principle of diversification becomes your most powerful ally. Diversification means spreading your investments across various asset classes, stocks, bonds, real estate, etc., and sectors, technology, healthcare, energy, etc. This reduces your exposure to any single investment's performance. If one sector underperforms, your other investments could offset those losses. Don't put all your eggs in one basket. Instead, consider constructing a portfolio that includes a mix of large-cap, established, well-known companies, mid-cap, companies experiencing growth, and small-cap, companies with high growth potential but also higher risk, stocks. Geographic diversification, investing in companies from different countries, can further mitigate risk. Fundamental analysis, digging deeper than headlines. While following market trends is important, relying solely on short-term price fluctuations is a recipe for poor investment decisions. Fundamental analysis offers a more robust approach. It involves examining a company's financial health, its competitive landscape, and its management team. Key metrics to consider include earnings per share. EPS indicates a company's profitability on a per-share basis. Consistent growth in EPS suggests a healthy and growing business. Price-to-earnings ratio, P/E, compares a company's stock price to its earnings per share. A lower P/E ratio might indicate undervaluation, while a higher ratio might suggest overvaluation. However, comparing P/E ratios across different industries is essential, as acceptable ranges vary. Debt-to-equity ratio measures a company's leverage. A high debt-to-equity ratio indicates significant reliance on debt financing, which can be risky. Revenue growth indicates the pace at which a company's sales are increasing. Sustained revenue growth often signals a strong business model. Cash flow measures the actual cash generated by a company's operations. Strong cash flow is a sign of financial health and stability.